All right, if you're thinking about making a move or buying a home in 2026 in the greater Lansing, Michigan area, then this video is for you. Because a question that I get a lot of times is, do I qualify for a conventional loan or not? And the problem is there's so much information out there online that's either outdated, oversimplified, or just flat out wrong. So today I want to walk you through conventional loan requirements and what that means for buyers who are looking to move in the greater Lansing, Michigan area in a way that makes sense. So no lender jargon, no scare tactics, just plain reality of how this works. So what's up everyone? My name is ⴨ I'm a top producing real estate agent in the greater Lansing, Michigan area. I get phone calls all the time from people who are just like you looking to make a move to Michigan, especially the greater Lansing, Michigan area. So whatever your timeline looks like, if you want to schedule a Zoom call with me, I have a link below, or a call or text, it's all in the description below. So feel free to reach out to me anytime. I'm never too busy to be able to respond to you. Also, if you could please like this video and subscribe to my channel because you'll be informed of when new episodes of Lansing, Michigan Life go live. We have new episodes going live once or twice a week. And we are the #1 YouTube channel for all of greater Lansing, Michigan area. If you scroll through my library, you will see tons of videos about every single suburb that's out there. You will be well informed. That was my purpose for this channel, for you to make a well-informed decision while you move out here, because it already is overwhelming to move. It's one of the most stressful situations that you're gonna go through in life. So conventional loan requirements. I know I'm not a lender, but I do know enough to be dangerous. And before I get into a little bit of the nitty-gritty with the loan, I do want to start with the basics, because it's like, what is a conventional loan? Well, if you've been doing your research, you see that there's an FHA, VA loan, residential development loan, or also known as an RD loan, and then also you have a conventional loan. So RD, VA, FHA, those are all government-backed loans. Conventional is not. So that means that there are less requirements. If you go for a FHA or VA loan or rural development loan, RD loan, what you will find is that there's an additional process through the appraisal that will give you safety requirements that are required. And sometimes those safety requirements have to be done before it's closed. And it can cause a little bit of a headache between buyer and seller, because some things that come up are unexpected. People don't know if they want to shell out the money for that. They've already been past the inspection process already, and then they feel like, hey, I've got another inspection I've got to do. So FHA, VA, while they are government-backed products and they might have some lower interest rates, there are some hurdles with that. So conventional is the cleanest. In fact, I'm a listing agent as well in the area. I sell lots of homes. I also help buyers just like you as well. But with my listing agent side, when I'm getting offers coming across the table, especially when I'm in a multiple offer situation, of course, cash is going to be king, but then conventional would come in second place. FHA, VA, RD, and it has nothing to do with bias at all or prejudice. It's just the loan type that is there. And I'm trying to do what's best for my seller. So when you're looking into loan types, what you have to keep in mind is that what is going to help me get into a house and help me win a deal. And conventional, if you can qualify for it, that's going to be your best bet over all the mortgage products that are out there. If you can get a conventional loan, also through a reputable loan company, local loan company, that's important as well too. And I do have information on a local lender in the description below who works with people from all over the greater Lansing, Michigan area. So I highly recommend you reach out to him if you're looking to get with someone local, because that's the other important thing. Also with conventional loans, it can mean better borrower profiles. When there's better borrower profiles, then the banks will make more incentive for people to go with that loan. So that means lower interest rates, lower long-term costs as well, and then more flexibility once you own the home. The beauty of conventional loans is that there's such a thing as private mortgage insurance, that if you don't pay 20% down or more, then you have to pay private mortgage insurance on the property. With conventional, at the 20% mark, when you have 20% of the house paid off, then that private mortgage insurance will fall off. So again, another perk as well. So how do lenders look at conventional loans? Well, I like to kind of envision this as a 5-part scorecard. Okay, I'm trying to, again, not try to use all this lender jargon here. I'm trying to keep it pretty simple. So I like to use a 5-part scorecard when explaining this. So first part, when a lender is trying to look at a conventional loan, they're evaluating your, number one, your income and job history. They're also looking at your credit profile, your down payment and your assets, number three, then your debt to income ratio, which I'll get into that again as well. And then number five, the property and lot size. So 5 things that they are looking at when you are trying to apply for a conventional loan that you need to keep in mind. So if you understand these 5 things, then you are ahead of most buyers, but those are the 5 things, to keep it simple, that lenders do evaluate. So in regards to your income and job history, let's talk income because this often trips people up because there are some misconceptions. People are going, okay, well, if I switch a job, like if I'm moving even from a different state, from one place to the next, and I switch jobs, is that going to affect my loan? Answer to that, no, as long as you stay in the same field or the same job. That should not affect you. Especially for those of you who are, if you're a physician watching this, keep in mind that my local lender that I have does a physician's loan where it's 100% finance, but that is a conventional loan. It's not FHA, it's not VA. So there are some really good products for that. But if you're going from one doctor's office to another doctor's office, that is not going to affect you getting approved for a loan. The time that's going to affect you getting approved is if you go from a different profession, like say you go from a doctor to you're working at McDonald's. I mean, that would be an interesting sight to see. I don't think I've ever seen that before. But let's say you just completely switch fields, A, or B, you are a W-2 employee, but then you decide, hey, I want to be my own employer. I want to be a 1099 contractor. If you decide to do that, that might affect the loan as well, because typically they want to see 2 years of stable employment, but if you switch your job out to some sort of different tax filing, that might be a little hard. Not saying that it can't be done depending on how much income you can prove that you have and how much you have in assets, but they're looking at your income, and yes, they want to show 2 years of steady employment, but if it's within the same field, it's fine, even if you're switching jobs. If you lose your job, that's not a good thing. And they will verify and make sure that you still are at your job, just to let you know. So they will find that out. If you are somebody that is self-employed, okay, I just talked about, you go move from being somebody that's not in the same field, but like let's say you move here and you might have an online business, but you're moving somewhere else and you're deciding to do your own thing here. Well, as long as you've been doing that business for 2 years, you're good. But if you just started it 6 months ago and you're looking to get a loan, that might make them a little shaky. Okay, so the things that lenders care about has to do with consistency, documentation, because you are going to have to give them W-2s or your 1099s, however you file your taxes for your employment. They're gonna wanna see those. And then even documentation from, like they're gonna wanna see pay stubs. Those are things you're gonna wanna keep handy online, get into your online account, or if they give you the old paper trail, whatever that would be. But also you wanna keep handy just verification of employment, because they're gonna do that towards the end. And they just wanna be sure that you're stable. I mean, that's a big thing with the income. So that's me touching on the income and how they do that. The second thing has to do with credit scores. And what's the real story with credit scores? Because you're hearing different things throughout the news of what does my credit score have to be to have a conventional loan? And to have a conventional loan, on average, you'll hear that the minimum credit score is around 620 for your credit scores. Technically true, but in real life, most lenders might go a little bit higher than that. 640, that goes from lender to lender, how much risk they want to take in taking a client on, because they want to have, again, very qualified borrowers to be able to buy a house. So they're going to be looking at that risk. That's why they have underwriters there evaluating all of this. So if you have higher credit, lower risk. But there's not like this certain like magic credit score that you will always get accepted at this. But if you're in the high 600s, low 700s, I would be safe to say that you would be all right with most loan companies. Again, if you're over 800, I mean, you're gonna get approved anywhere, okay? So this isn't though just about qualifying, it is about your monthly payment. So you do need to pay attention to what that monthly payment would look like if you do have a lower credit score. For 2025 to 2026, I know that I mentioned there's some 2026 changes. So I'm gonna talk about the credit score change here, since we're on credit score. The 2025-2026 credit score change. There are some misconceptions with that because people are saying, oh, now you can get a loan without having a credit score. And honestly, that is not really true. It's a half truth. So it is a little easier to be able to get a loan if you don't have a credit score. But if you don't have a credit score, your interest rates are going to be huge. So what that means for you is that, yes, certain profiles don't require a credit score. Fannie Mae, which does the conventional loans, they don't require to have a credit score anymore, but it is according to your lender and what kind of risks they're going to take. So it's not a guarantee. So if you've been hearing all these headlines about, I don't need to have a credit score anymore. Well, that's half true. I've had some clients be able to still get a conventional loan without a credit score, but you gotta have a really good borrower profile. There are other things to consider with that, okay? And again, this was something that was at the end of 2025 going into 2026. So that is newer information that they have loosened the restrictions a little bit on that. So for down payment, how low can you go? Because I just had a discussion yesterday with one of my sellers who, when they bought the house, they said, yeah, my balance on my mortgage, it's whatever's required. Like, I think it's 20% or more, right? And I think a lot of people in their heads think that you have to have a 20% down payment to be able to qualify for a conventional loan. And that's not true. There are plenty of conventional loan products where you only need to have 3% down. Now, keep in mind, you also have closing costs that you would have to be accountable for. So it's not just the down payment. You do have additional closing costs that you would have to pay at the close table. So sometimes, and I'm not meaning to knock FHA or even VA. Sometimes FHA, VA, they might have a lesser monthly payment depending on how much money you are willing to put down, and they could be the best product for you. However, keep in mind, and this is the one tip I will give you, if FHA and conventional, FHA is a little bit cheaper, the thing that you have to consider when moving here is, if I'm looking to move here in April, May, June, when it's the height of the market, when all these buyers are out there and there's more competition, do I want to go for a loan that's gonna be a lower interest rate, or do I want to actually win in a deal and buy a house? Because conventional, more times than not, even if you give such a high price with your FHA, you give a huge asking price, over asking price, okay? Sometimes, if the terms are better with conventional and people see it's safer, they might assume, hey, they have a better credit score. Hey, this won't fall apart, okay? You have to keep that in mind. Just because your monthly payments might be a little bit less when you compare some of the loan products, you also have to know the market. And in Lansing, conventional is going to be the best loan type. So if you can qualify for conventional and it's not going to affect your monthly payments all that much, you might want to consider still going with conventional, even if FHA and VA might be a little less, okay? And I know that there's other perks with FHA and VA that you would have to talk with a qualified lender about, but that's just kind of my 2 cents there. What I want to get into, again, PMI, private mortgage insurance. This is something that people hate. So if you give less than 20% down, you will have private mortgage insurance. It protects the lender, not you, in case you default on your payments. You have enough equity in the house that if you're over 20%, that's not gonna be a big risk. But if you have less than 20%, that could be a risk where you take a loss and then the lender's going, okay, what's gonna happen with this house here? They're gonna be able to pay it up, or we're gonna have to foreclose on this. So PMI can be removed once you have that 20% or more equity. It's usually something that's automatic, but sometimes they might miss it. So if you have that 20% or more down, PMI, gone. If you're at 10%, 15% down, you only need that extra 5-10% to be able to get rid of that PMI, private mortgage insurance, altogether. Overall, it's not permanent, which is a huge perk over FHA, because with FHA, PMI rules look a little different. So debt to income, that's one thing that I also talked about, the debt to income ratio and why this matters. So debt to income, this is gonna be a big thing. They're going to ask for you to give your income, proof of income, documentation, W-2s, taxes. The lender's gonna ask for you to give all that documentation to prove it. Then they're gonna ask you, what debt do you have? Now the debt usually includes student loans, also includes car payments and credit cards. It doesn't include, hey, I pay this much amount in groceries a month, or I pay this much a month in gas, or I have subscriptions here. It's not what it talks about. They look at your credit card debt, car payments, student loans, and also they'll look if you have another house somewhere else. That's gonna be a thing to consider too. So the debt to loan income ratio, how does that work? So they're gonna take your monthly debts, they're gonna divide it by your gross monthly income, your gross before taxes, okay? Then they're going to look at that percentage, and usually the magic number is around 45% debt to income ratio. If you're right there at 45%, you are good. But if you are flirting with that and it's less than that, then you will probably not get qualified. Just as a heads up there. But another tip I want to give you, you have to do what's comfortable with your monthly budget. You could be promised all this money for a house, but you know what your monthly budget is. So stay true to that, 100%. Don't feel pushed to getting something from a lender there. The loan limits for 2026, this is a new update for you. The loan limits have increased. So to get a conventional loan, the maximum loan they'll give is $832,750. So that matters in Lansing. Why? Because our average home price is $250,000. If you go to ᴏ괰ᴰ, average is around $450,000, $475,000. Some of the suburbs that are more popular, it's flirting around $400,000 for average home price. But $832,000, if you have 20% down, that's over $1 million or close to $1 million house. And there are some $1 million homes here, but for majority of you, you will be able to qualify for a conventional loan. Otherwise, if it's above that limit, you'll have to go for a jumbo loan. Rates look a little different for that. Rates are higher for a bank to be able to give you a jumbo loan. I'm not gonna get into more specifics with that, but for majority of homes in Lansing, this is good news, $832,750. You're gonna be able to qualify for the best rates if you have 20% down especially, okay? So pre-qual versus pre-approval. This is another important thing to consider because there are some online companies that they'll say, yeah, we'll pre-qualify you and we'll have a conversation. It sounds like you could get qualified, so we'll give you a pre-qualification. If I am a list agent and I'm hearing all this info, I'm gonna go, wait, pre-qual, they just had a conversation, well, have they verified anything? That's where pre-approval comes into place. When they verified your W-2s, your assets, and they have that verified, then they'll give you a pre-approval. So be sure that you get a pre-approval before you start looking at homes. Pre-qualification, that's not going to help you, okay? Be sure that you give documentation to a lender when they need it. They're going to ask you for that. Some lenders right now are online, like my local lender, and again, information is in the description below, but there's a link that you can click on that you can just apply online. They'll ask for the documentation, make it pretty easy, be able to give you some sort of notification sooner rather than later. Okay, with that being said, hopefully all this information is helpful to you when you're looking to make a move here. I hope that you are able to know a little bit more about how the loan process goes, and especially like you need to have a plan to be able to get with a lender before you start looking at homes here. And especially a local lender, that is going to be huge. Local lender, conventional loan, those are going to give you the best terms when you are in a competitive offer situation. If you're looking for help for that, you're looking for help to make a move, all my contact information is in the description below. Call me anytime. Zoom call is what I prefer because we can have a little bit more face-to-face interaction, get a little bit more done, just a conversation what your goals are. But you can text me, email me as well. Also, if you are looking to relocate anywhere in Michigan or around the country, and maybe Lansing isn't where you're gonna land, but you're looking to move somewhere else and you're evaluating things, I do have a network of people that I trust and know that will be able to give you some great service as well. So reach out to me if you need a referral. Also, like this video, give it a thumbs up, and subscribe to my channel just so that you can be notified when a new episode of Lansing, Michigan Life goes live. And we have these new episodes going live once or twice a week. So until the next one, I hope you take care and make it a great day.